Right now, there is a $75,000 tax bill hiding inside your home. Not in your mailbox, not on some IRS notice you forgot to open, inside the walls of the house you have lived in for 20, 30, 40 years. And the IRS does not need to audit you to collect it. Their automated systems already know what your house sold for. They already know what your property records say. They already know who is on that deed. And if you made any one of 4 extremely common mistakes that your real estate agent never warned you about, that your attorney never flagged, that your own children may have accidentally caused, you will owe the IRS tens of thousands of dollars that you should have never owed in the first place. April 15th is 10 days away. After that date, the penalties start compounding. 5% per month for failing to file, 0.5% per month for failing to pay, 7% annual interest on top of all of it. And here is the part that should make you furious. The IRS just fired 7,000 employees. Nobody is answering the phones. But the automated penalty systems are still running 24 hours a day. The computers do not get fired. The computers send the notices, calculate the penalties, and file the liens on your home while you sit on hold waiting for a human being who no longer works there. I am going to walk you through the 4 traps hiding inside your home right now. I call them the home traps. H for home equity mistakes, O for ownership and deed changes, M for move-out timing, E for extra income. Each one can cost you anywhere from $8,000 to over $75,000. And the worst part is most people who fall into these traps had no idea they were doing anything wrong. I am going to show you exactly how each trap works, exactly how much it costs, and exactly what you can do before April 15th to protect yourself. Then I am going to give you 3 things putting money back in your pocket that almost nobody is talking about. And I'm going to finish with a 7-step checklist you can complete this week. But first, let me tell you about Margaret. Margaret is 71 years old, lives in Ohio. She and her late husband bought their home in 1986 for $82,000. Her husband passed in 2019. The house is now worth $395,000. Margaret did 2 things she thought were smart. She added her son Michael to the deed so the house would pass to him easily. And she took out a home equity line of credit for $40,000 to pay off medical bills and help Michael with a down payment. Margaret had no idea. Those 2 decisions created a tax bill of over $68,000. Let me show you exactly how. Trap number 1, H, home equity mistakes. Before 2018, if you took out a HELOC, the interest was tax deductible, no matter what you use the money for. Credit cards, car, vacation, all deductible. That changed January 1st, 2018 with the Tax Cuts and Jobs Act. Under current law, HELOC interest is only deductible if the funds were used to buy, build, or substantially improve the home that secures the loan. If you use your HELOC to pay off medical debt, not deductible. Help your child with a down payment, not deductible. Consolidate credit cards, not deductible. And if you have been deducting that interest anyway because you did not know the law changed, you have been filing incorrect returns every single year since 2018. Margaret took out $40,000, used $20,000 for medical bills, and gave $20,000 to Michael. She deducted all the interest for 6 years at 12%, roughly $3,000 per year in interest that was not legally deductible. The IRS automated underreporter program cross-references your return against what banks report on Form 1098. It can flag that discrepancy without any human ever looking at your file. Tax owed on those improper deductions plus penalties and interest comes to approximately $12,600. Margaret does not know yet, but the computer does. And many tax software programs still ask a generic question about mortgage interest without asking what the HELOC funds were used for. If you typed in your 1098 number and clicked Next, the software may have automatically deducted interest that should not have been deducted. The IRS holds the taxpayer responsible, not the software company, not the tax preparer. Trap number 2. Ownership and deed changes. This is the big one. The one that destroys families financially because it comes from a place of love. Parents add their adult children to the deed to avoid probate because a neighbor said it was smart because they want to make things easier. And in doing so, they trigger 3 separate tax consequences. Consequence 1, adding your child to the deed is a taxable gift. If your home is worth $395,000 and you add 1 child as a 50% owner, you just made a gift of $197,500. That is well above the annual gift tax exclusion of $18,000. You are required to file Form 709. Most people never do. Most people have never heard of Form 709. Consequence 2, this is where the real money is. You just killed the stepped-up basis. When you die and your child inherits the house, the value resets to fair market value on the date of your death. You bought the house for $82,000 or $395,000 when you die. Your child's basis becomes $3.95. They sell it for $400. They owe tax on $5,000, almost nothing. But when you gift it by adding them to the deed while you are alive, they get your original basis, $82,000. They sell for $395,000. The taxable gain is $313,000. On the gifted half, that is $156,500 in taxable gains. At 15%, $23,475 in federal tax on a house that would have cost them $0 if you had simply left it in your will. Consequence 3, your child does not qualify for the Section 121 exclusion on their portion because they never lived there as their primary residence. Michael lives across town. His entire share of the gain is taxable, every penny. That decision Margaret made at the county recorder's office created approximately $30,000 in additional tax liability. Add the $12,600 from the HELOC and she is already at $42,600. Trap number 3, move-out timing. This one is devastating for seniors who left their home for health reasons. Section 121 lets you exclude $250,000 in gains, $500,000 if married, but you must have lived in the home for 2 out of the 5 years before the sale. That is the 2 out of 5 year rule. Here is how it destroys people. You are 68, lived in your home 30 years, you have a health scare, a fall, a stroke. You move in with your child for care. You intend to sell, but the market is bad, or you are recovering or selling is the last thing on your mind. 3 years pass. You are ready to sell, but now you have not lived there for 3 years. You no longer meet the 2 out of 5 year rule. Your exclusion is gone. $300,000 in appreciation means $45,000 in capital gains tax. There is a partial exclusion under Section 121 subsection C for health-related moves, but it is not automatic. You have to claim it correctly and document the medical condition. It is prorated based on how much of the 2-year requirement you met. If you live there 18 of the required 24 months, you get 75% of the exclusion. The rest is taxable. If you did not know this existed and your accountant applied the full exclusion, the IRS will catch the discrepancy between your Medicare address change, your postal service records, and your claim of full primary residence exclusion. Trap number 4, extra income from the home. When you rent out your home or even a room, the home changes tax classification. It becomes partially or fully an investment property. That triggers 2 major issues. Issue 1, depreciation recapture. The IRS requires you to depreciate rental property over 12 years. When you sell, that depreciation is recaptured and taxed at 25% under Section 1250. Here is the cruel part. Even if you never claim depreciation, the IRS calculates recapture based on what you were allowed to claim. You got no tax benefit during the rental period, but you still owe the recapture tax when you sell, on a structure worth $240,000 rented for 5 years. That is roughly $10,900 in recapture tax. Issue 2, if you rented the property for more than 3 years out of the 5-year look back, you may fail the primary residence test entirely. The full gain becomes taxable. Add it all up. HELOC deductions that were not legal since 2018. Deed changes that triggered gift tax and killed the stepped-up basis. Move-out timing that eliminated the exclusion. Rental income that created depreciation recapture. Anyone cost $5,000 to $30,000, 2 or 3 together $40,000 to $75,000 in taxes, penalties, and interest that you could have avoided. Now let me flip this around. I do not just come here to scare you. I come here to put money back in your pocket. Number 1, the senior bonus deduction. The One Big Beautiful Bill Act created an additional standard deduction for taxpayers 65 and older. Single, you get an extra $6,000. Married and both over 65, $12,000 on top of the regular standard deduction. Phases out at $75,000 in modified adjusted gross income for single filers. Available for tax years 2025 through 2028. 4 years. Use every one of them. Ask your preparer directly, did you apply the senior bonus deduction? If they look confused, find someone who does not. Number 2, the SALT cap increase. State and local tax deduction was capped at $10,000 since 2017. As of 2025, the cap is $40,000. If you live in New York, New Jersey, California, Connecticut, Illinois, this is enormous. The property tax of $15,000 plus state income tax of $12,000 means you can now deduct $27,000 instead of $10,000. At a 22% bracket, that puts $3,640 back in your pocket, but the cap drops to $4,400 for 2026. That is not a typo. 2025 is the year to maximize this. Number 3, the energy credit. Solar panels, heat pump, energy-efficient windows installed in 2025 qualify for a 30% credit. Dollar for dollar off your tax bill. $20,000 system gives you $6,000 back, but this credit is killed for 2026. Gone. Not reduced. Gone. Bonus: state property tax homestead exemptions. Almost every state offers property tax reductions for homeowners over 65. Texas saves $4,000 to $6,000 per year. Florida freezes your assessed value. Georgia exempts school taxes entirely, but these are not automatic. You have to apply at your county assessor's office. If you are over 65 and never applied, you have been overpaying for years. Now, Dorothy, this is what happens when all 4 home traps hit one person. Dorothy is 68, Tennessee. Bought her home in 1990 for $94,000. Husband passed in 2017. Home was worth $320,000 at his death. She got the stepped up basis. Remember that number. $320,000. In 2020, Dorothy had a stroke. Her son James moved her into his home. They rented her house for 3 years. During the rental, Dorothy's estate attorney suggested adding James to the deed. She signed the paperwork. No one filed a gift tax return. In 2024, they sold for $420,000. The deed changed, $200,000 gift, no form. 709 filed. The basis James got Dorothy's carryover basis on his half, $160,000. His half sold for $210,000. Taxable gain of $50,750 in federal tax. The move out. Dorothy was out for 4 years. Does not meet the 2 out of 5 rule. Qualifies for a partial health exclusion. She did not know to claim the rental. 3 years of depreciation recapture, $8,750 at 25%. Total $23,400 on a home she owned for 34 years, on a gain that should have been almost entirely excluded if she had left the deed alone, sold within 2 years, and never rented it. Dorothy cried in the CPA's office. She said, "I just did what everybody told me to do." The IRS does not care about intentions. The code does not have a provision for good intentions. 7-step checklist. Complete every one before April 15th. Step 1. Pull your IRS transcript at irs.gov. Free Get Transcript tool. Pull your account transcript and wage and income transcript for 3 years, compared to what you filed. Any discrepancy means you have a problem. Step 2. Check your deed at your county recorder website. If anyone was added at any point and you never filed Form 709, talk to a tax professional this week. Step 3. Review your HELOC usage. If any borrowed funds went to anything other than buying, building, or improving the home, that interest was not deductible after 2017. Amended returns you file voluntarily. Qualify for penalty abatement. Corrections the IRS forces on you do not. Step 4. Check your residency timeline. Count the months you lived there in the last 5 years. Under 24 months means no full exclusion. If you move for health reasons, get a letter from your doctor. Now, step 5, calculate depreciation exposure. If you rented any part of your home, even one room for a few months, recapture may apply when you sell. You owe the recapture whether you claim depreciation or not. Step 6, apply for your homestead exemption at your county assessor's website. Many states allow retroactive applications going back 1 or 2 years. Step 7, file or extend by April 15th. Form 4868 gives you until October to file, but an extension to file is not an extension to pay. Estimate what you owe and pay with the extension. The failure to file penalty is 5% per month. Failure to pay is only 0.5%. Filing the extension eliminates the larger penalty. And if this is your first issue with the IRS, ask for the first-time penalty abatement program. They will waive penalties if you have a clean 3-year history. You have to ask. They do not offer it automatically. If this video saved you even once, hit like and subscribe. I have an entire video coming on Form 709 because the gift tax rules are a minefield that almost no one understands. Share this with anyone over 60 who owns a home. Send it to your parents. Send it to the aunt who added her kids to the deed 10 years ago and thinks everything is fine. It is not fine, but it can be fixed if they act before April 15th. Drop your questions in the comments. I will see you in the next